Now we combine all the pieces we've learned into one repeatable setup. This is where it gets real. Instead of guessing, we're going to follow a specific formula every single time you open a chart. Before we dive in, let's quickly recap parts 3 through 6. We already know how to pick a pair, find the trend, identify key levels, and wait for that final confirmation signal from the candles. This is your core formula. Trend plus pullback plus confirmation plus fixed risk. Write this down. Without all 4 parts, there is no trade. We don't skip steps, especially not the risk control. You might wonder why we only learn one setup first. It's because repetition beats random strategies. Professional traders don't trade everything. They wait for their specific A-grade setup to appear. Let's look at the long setup rules. First, the daily trend must be up with price above the 200 SMA. Second, on the 4-hour chart, the 20 EMA must be above the 50 SMA. This confirms momentum. Third, we wait for a pullback. Price needs to drop into a support zone or near those moving averages. Fourth, we need a bullish confirmation candle, like a pin bar or engulfing candle, at that zone. We enter just above that confirmation candle. Our stop loss goes safely below the recent swing low. Our target should be at least double our risk. That's 2R, or right before a major resistance level. Now for the short setup. It's the same logic, just reversed. Daily trend must be down below the 200 SMA. On the 4-hour chart, the 20 EMA should be below the 50 SMA, showing us the bears are in control. Wait for price to rally back up into a resistance zone or the area between the moving averages. Look for a bearish confirmation candle. This is the signal that the trend is ready to continue down. Entry goes below that candle, and the stop loss goes above the recent swing high. Protect your capital. Let's look at a real example on EUR/USD. Notice the clear uptrend above the 200 SMA on the daily. Price pulls back right into our zone. This is where we get patient and wait for the signal. There it is, a perfect bullish pin bar. This is our confirmation that buyers are stepping back in. We set our entry, our stop, and our target. Then we let the market do the work. Don't touch it. Next, let's see a short example on GBP/USD. The trend is down and the EMAs are fanned out. See how price rallies back to the resistance level? This is the pullback in a downtrend. We get a bearish engulfing candle right at the zone. That's the green light to look for a short entry. Again, we manage our risk with a 2R target. Consistency is about following the math, not hope. What makes a setup A-grade? It's when everything is clean, a very obvious trend and level. You want a clear confirmation candle and a market that isn't about to be hit by major economic news. Now, what should you skip? If the chart looks like a mess or choppy, just walk away. Never chase a trade that already moved, never trade without a stop, and avoid targets too close to support. That confirmation candle is your trigger. Once it closes, your entry and invalidation points are set. If price goes past your stop loss, the setup is invalidated. It's not a failure, it's just one data point. Always aim for at least a 2R reward. This means if you risk $10, you're aiming to make 20. With 2R trades, you can lose more than half your trades and still be profitable over time. Let's test you. I'm going to show you a chart. Look at it carefully and tell me if it meets our criteria. Look at the trend and the moving averages. Is this a setup we should take? No, it's too messy. How about this one? Yes. Trend, pullback, and confirmation are all there. That's an A-grade setup. A common mistake is taking 3 out of the 4 requirements and pretending it's enough. It isn't. If you don't have confirmation or if you're trading against the trend, you're just gambling. Here's your master checklist. Start with the pair, verify the trend, and find your pullback zone. Check for confirmation, set your entry and stop, and calculate your target. Almost there. Finally, check the news and make sure you're in a calm mindset. If you're angry or tired, don't trade. Time for your assignment. I want you to go back into the history of EUR/USD, GBP/USD, and USD/JPY. Find 20 historical examples of this setup. Label all 4 parts for every single one. Remember, this is educational only. Forex is risky, so always practice on a demo account first. If you're a miner, make sure you're following all legal and Guardian compliance in your area. You've got the strategy, now you need the math to survive the inevitable losing streaks. In Part 8, we'll learn the math that keeps one bad trade from hurting you. I'll see you there. Practice those 20 examples. The more you see it, the easier it becomes to trade it.